welcome everyone to today's spotlight, where we're going to focus in on a very interesting company, a very interesting organization, Base Carbon, that listed on NEO, if my memory is correct, Michael, on March the 3rd. So we're getting close to the 6 months anniversary. A company active in carbon projects, a company involved with carbon credits, words that we hear a lot in an environment that is very sensitive to coming with initiatives to take us towards net zero within what's starting to become a pretty nearby future. We have with us CEO of Base Carbon, Michael Costa. Michael, welcome, and thank you for joining us.
Thank you for having us again. It's really nice to be connected in this forum again.
Thank you to all those in the audience for joining us, and feel free to ask some questions. You can leverage the Q&A function on Zoom, and I'll make sure that your questions are put forward to Michael, and what we cannot tackle in today's session, we'll make sure is forwarded to Michael so that he can get back to you afterwards. Michael, first things first, tell us a little bit more about Base Carbon. What is Base Carbon? What is Base Carbon doing? And I think there's still a lot of people out there who don't always fully understand what a company like yours is doing. Might be quite a few people who do understand it, but there's still a lot who don't understand what a company like yours is doing. And it is pretty interesting and amazing, in fact.
Well, thank you for that, and we certainly think it's interesting. Base Carbon, though, is a really simple company and a really simple idea, but it's in an asset class in voluntary carbon that is novel to public markets and public investors. In a really simple nutshell, Base Carbon is a investor, is a financier, is a project developer to voluntary carbon credits and upstream voluntary carbon credits. So really simply, we use our capital, we use our expertise, we use our competitive advantage and where we have edge to develop carbon projects, things like household device projects, which we've done two of which, cook stove projects, which we can talk about today, or things like afforestation, reforestation, whereby we're planting trees, or things that involve technologies, but proven technologies, all things that either abate carbon from being emitted into the atmosphere, and carbon that would have definitively been emitted if we didn't take these economic activities, or sequestering carbon out of the atmosphere. And the primary, I would call it technology, I'm air quoting for the people that are listening, that we have right now as a species are trees. So we as Base Carbon fund these projects. Carbon is abated or removed from the atmosphere, and we generate a carbon credit. And those carbon credits are sold to carbon emitters that want to reduce their carbon footprint. So that is the whole concept of net zero. It's not zero, and companies don't emit carbon, but companies emit carbon for really good purposes. Telecommunications, travel, hydrocarbons that enrich lives, help humanity in a number of different ways. But it still emits carbon. We're the other side of that. We're the other side of the net equation.
Yep. So, and I'm zooming in on this a little bit, just because I want to make sure that everyone who's on really gets it. Like Base Carbon is coming with projects, and I think you mentioned the cook stove one. That one is in Rwanda, am I correct?
Yeah, and we have a second one in Vietnam as well.
And you have a second one in Vietnam. It's all about having a positive impact on carbon emission, or avoiding it, or reducing it. But you're not doing that as a charitable organization. Otherwise, you would not be listed. So it allows you to acquire carbon credits, and there's a market for that. Could you tell a little bit more about the carbon credits?
Yeah, I think it's a really good question. And it's the provenance of how the carbon industry and we as a species have gotten to this point is really important. So when people think about Kyoto Protocol, which most people have heard about, from the late 90s, what developed were things called compliance markets. So certain governments put in place regulation that said, and primarily cap and trade systems that people will be familiar with on this call from other industries, whereby there was a regulated environment where you were only allowed to emit a certain amount of carbon. You could trade if you were under, you could trade with companies that were over. And there was an allotment in there for carbon offset projects, 5%, 10%, depending on the various carbon scheme in the world. And that's what really developed the voluntary carbon industry. As companies moved their focus from a focus solely on making money to where we're at today, and where we're continuing to move to today, of thinking about their stakeholders, and one of those stakeholders being the environment. Companies like Microsoft, companies like certain hydrocarbon companies, mining companies have made net zero commitments. And they have been, in greater numbers, net zero commitments are being made. And we see that day in and day out in our business, which makes us very, very bullish on the overall voluntary carbon space. But if you think again about how we've gotten here, this is not necessarily a new thing. It's just the pace that's become new. So the buyers of voluntary carbon credits are these companies that have made net zero commitments. They've emitted carbon. Yep. Now, the question is what's compelling these companies to do it? In the compliance markets, it's government driven. You have to do it. In the voluntary markets, right there in the syntax of the word, it is a voluntary activity, but it's an activity that, I don't think that the carbon emitting companies in the world are uneconomic. I don't think that they're stupid. I think they're actually highly sophisticated, and they're thinking about two things. Number one, they're thinking about the demands of their stakeholders, their customers, and their shareholders. Yep. And they're thinking about the longevity and duration in their business, and thinking about how the world turns that way. In your point, the timeline to net zero is becoming ever more short. That's really the background of the voluntary market. And these companies pay us money for generating voluntary credits for them. And it's a really simple equation, in the same way that, an oil and gas company may pay a food services company to provide food to their camps, because they're not in the business of food, they're in the business of oil and gas. It's the same way here. We're experts in developing, investing, financing, and managing these projects, and they're experts in whatever their business is.
Yeah, and carbon credit is fundamentally, where you are generating your revenue, correct?
100%.
And what is also important, of course, to you is the evolution of the price of the carbon credit. How do you see? Oh, no, let's not do that. Let's not get into the how do you see. What are the key factors that you see impacting the price of carbon credits?
Yeah, it's really, really good question. We spend an incredible amount of time talking to our investors and stakeholders around what price. Before you get into how do you see price evolving, I think you have to talk about what a price is and what a price is in carbon. We're all, as people that have spent their careers, and probably a lot of the folks on the call today within the commodity complex, you think about the price of gold, ubiquitous around the world. Transportation and there's some storage costs. Transportation's not that expensive. That's fine. And then you think about things like oil that has a differential, but you still have benchmark prices around the world. There really isn't a carbon price. And there's a couple of reasons for that. It's an OTC upstairs market, B2B market. We do believe that there will be a carbon price over time, but that carbon price it's going to be a lot more like oil, where you have differentials that trade, as opposed to a ubiquitous price on something like gold. And the reason for that is that there's different, and we see it in our business. There's different types of demand for a household device project versus a afforestation, reforestation project. There's different durations out the curve of when those credits will be delivered. There's difference between abatement versus sequestration. And there's differences in the perception of additionality over time. So there really isn't, even as time approaches infinity, there won't be a price. There will be a range of prices that all reference back to the molecule of carbon, or other molecules that reference carbon equivalency. But there is no price. As we sit here right now, there aren't even those benchmarks. So for us, one of the key things that we've really focused on in our business isn't just the project side, the supply side. It's on the demand side. So there, and coming especially with a novel asset class to the public markets, to prove to our investors, to prove to our stakeholders that voluntary carbon isn't only a good idea, but this is a real durable, fundamental economic widget. that is off-taken by the largest companies in the world. So as evidence of that, on our second project, you talked about our two household device projects. On our project in Rwanda, we're a merchant. We're the principal. And we may do something with those credits over time, but we are the principal. We're generating those ourselves. On our project in Vietnam, we're the principal investor, but we're working with Citigroup, multi-$100 billion enterprise value business that I guarantee everybody on this call knows, that is off taking the credits from us. And not, hey, we might do this. It is a fundamental offtake. And on the next project that we're working on is a afforestation, reforestation project that we're working with a similar pedigreed and capitalized and similar, credit quality counterparty for offtake of our credits. So for us, the proof's in the pudding with any business, if you take it away from the commodity space, of I can generate anything in the world, but is there a customer? That's one of the fundamental premises of business. And for us, we see the demand massively outstripping the supply in the industry broadly, and even within our business as we talk to more and more off-takers and they understand what we're doing, they understand the quality of what we're bringing to the marketplace.
Yeah, and having a name like Citigroup that is standing next to you, that's a serious statement in itself. That they are pretty committed to that cause. One question that came in that is quite interesting is there's been recently a ban in India on the export of voluntary carbon offsets. Assume you're aware of that, and
Yeah.
there's also some comments about Indonesia putting certifications on hold.
Yep.
What do you think about that? And is that creating uncertainty?
Yeah. So those are two different matters, but it gets to the where those two converge is thinking about jurisdictional risk and governmental risk when you think about carbon. On the Indian matter, it's really a question of, in our opinion, how you interpret Article 6 of the Paris Agreement over time. And that's, there's a lot of time and energy that's spent on that. There's a lot of time and energy at the largest, carbon conference in the world, COP every year, of government officials and stakeholders attempting to adjudicate what that means and how it'll be interpreted. But fundamentally, we're not here to take a view on government policies. And when you think about carbon credits can't be exported from India, there's more than enough carbon emitters in India. There's more than enough companies that are Western world companies that have operations in India that are going to need to offset within there. So we're not particularly worried about that. We are looking at certain things in India. We think it's actually a very attractive place for certain methodologies, and where that doesn't scare us. From an Indonesian standpoint, it's a different matter. There's a relatedness, but it's different. And I think when we look at projects, it moves it away even from the governmental risk standpoint and thinking about as investors, as me as a portfolio manager, managing billions of dollars for the Goldmans and the UBSs of the world, of how do you manage risk on a structured transaction. And when we think about those, binary, sometimes unboxable governmental risk, it gets to how we underwrite the risk reward. So we may manage that through sizing of the investment. We may manage it through structure in terms of how quickly or not we choose to get cash flow back. We may, manage it through counterparty risk and offtake. But we have a lot of tools and experience to be able to manage that risk. So, I feel like it's a little bit different than some other commodities where you have physically bounded commodity that those binary risks that you take are much more ones that are forced upon you, as opposed to us with a digitally native commodity to be able to structure around it.
Yeah. And you bring me by talking a bit about your tools, about your experience, about your capabilities to another question. What makes your organization unique? Like when I look at this space, carbon credits is not a new concept, but the voluntary market, the way it is growing now, the companies focusing on carbon projects is really something we have seen accelerating, in a fairly recent past. And there's more and more companies out there, more and more companies going public, more to come. What makes you different? How should I differentiate? What should I look at if I want to be part of this? Because this is one of those few investments where you can both do something that is good and impactful and generate revenue. So it's almost like a dream coming true when it comes to investing. But how do I make sure that I pick the right ones, and what makes you unique?
Yeah, I think there's a couple of key points in there. To your latter point of doing something economically valuable and with great risk reward characteristics and doing something really good for the world. That's why our team is doing this as well. It's an ethos that flows through what we're doing from an individual level for myself all the way through our organization. To your point though on what makes us unique, I'm going to twist that word just a little bit because, again, going back to my time on the other side of the table from the folks on the call here and allocating capital, I was less worried about how a company was unique. And I really worried a lot about where they have edge and where do they have moat. And I think edge is really, really important. And I think that where we have edge, it's the bringing together. There's nothing new within carbon. There's nothing new within base carbon. So we're bringing together a portfolio management, risk management, structured finance skill set. That's been done for the last 100 years plus in Western world finance, not anything new. We talked about the provenance of voluntary carbon. The voluntary market's been in existence for over 20 years. There's nothing new. The methodologies that we're underwriting, that we're utilizing in our projects, we're not taking new risk here. The cook stove methodologies have been in place for the better part of 20 years as well. So there's nothing new, but these skill sets have never really been put together under the same umbrella, particularly within a public company. It's been done from time to time with boutiques. It's been done, but it's never been done in this well capitalized of a format, and it's never been done in this market environment. So I think that for us, where we have edge is our experience in doing carbon projects. We've done them before, we've developed them, we've overseen them, and we've overseen them at some of the largest firms in the world. Our experience in allocating capital and being structured financiers, we've done billions of dollars worth of transaction that way across both our management group and our board. And then thirdly, on a public company standpoint, this isn't our first public company. All of us have sat on, I've sat on multiple boards. Our CFO, Wes Fulford, has been a CEO of a large public Canadian company as well. It's all our connectivity to Abex Technologies and our partners and our business friends there, and the access and the technological assistance that we get from that business. I think that those are pieces of our business, and that you can't create experience over a short amount of time. You can over a long time. But this is a marketplace that's going to develop over a very short time, to your point. And I think that bringing those pieces of experience together is where we really have edge.
Yeah, is another way to put it professionalism. That is what experience and quality people are. That is professionalism. And if I come back to my earlier point, how do I look at companies like yours coming to the market? The message is probably look at the people who are running it and operating it and do that test. Because what we also know, and we talked about that in the past, Michael, that is when you have a new sector emerging, and it may be a little bit slowed down for the moment because of the market conditions, but that's just a matter of time. We know there's a lot bubbling over there. There's going to be lots of good things coming out, but there's also going to be some initiatives that we all have to be very cautious about. So analyzing and looking at a company and understanding it is very important. And you mentioned you give me every time a nice way to move into my next topic. You mentioned well capitalized. So I was looking at your latest financials. You guys are in a solid position. You have been putting capital at work, but you're still sitting on a substantial amount of capital. What is the way forward? Tell us a little bit more about your ideas, your strategy going forward, short term with respect to allocation of capital, and then longer term, which is not only about allocation of capital, but probably also raising more capital. There's a few questions that came in about, how are you looking at growing the business,
Yep.
in the months and years to come?
Absolutely. So there's a lot in there to unpackage. So I'm gonna go slowly and systematically and pause.
Questions are easy.
Yeah, exactly. I'm learning that as I said, on the other side of the table from being the guy that asked questions for the last 20 years. But to answer your question, you're right. We are well capitalized. As of the end of the last quarter, we have $37 million on our balance sheet. We've made 2 investments. We've invested in our Rwandan cook stove project, and we've invested in our household device, primarily cook stove Vietnam project. And we have commitments out to those. We'll use some of that capital fulfilling those commitments. As we said in Q2, we're ahead of schedule on device distribution in both of those projects. So that's we're very much under promise and work very hard to over deliver kind of guys. And we're very pleased with the progress there and with the nature of our partnership with both with the Del Agua Group in Rwanda and with SIPCO in Vietnam. To the question around how do we allocate capital, we could, if everybody could allocate to us, the next couple of weeks of their time, we could have a really, really long and interesting conversation about capital allocation. But fundamentally, within our business, we're prudent investors. As I said before, we're doing methodologies, we're doing project types that we have edge in, that are proven, that we know have durable offtake and durable demand in the marketplace. We're certainly looking at novel things. We're going to focus our time there, but it's a small percentage of our time until those things become proven. And I think that's when you are capitalized, that's a really prudent way to develop an investing business. We don't feel like with the returns that we generate in these projects, and I urge everybody here to go take a look at some of our public disclosure. But with the returns that we generate in these projects, we don't really need to go out on the risk curve, in our opinion. The base case of investing in projects and simply systematically and thoughtfully putting one foot in front of the other as we move forward generates us multiple of money returns. So that's without upward sloping carbon prices. We talk about prices, but we do think that the overall complex of voluntary pricing does go up as that complex develops. The other thing that I think is really important when you think about projects overall and you think about capital in our business is that I think a lot of, and I came this way, I come from a large, extractive industry commodity background in my investing practice. And one of the things that you intuitively learn investing in, let's say, mining companies is early stage mining companies raise money, then they go drill. And if they hit something good, which is good for you as an investor, your reward is that they dilute themselves to go do infill drilling. And then if you win again, your reward is that they dilute themselves to run a PEA and eventually, finance their mine. And then you wait 2 or 3 years for the mine to turn on. And many of them work, some of them don't work. And then they need more capital to, do more development or whatever the case may be. I think that feeling is ingrained in investors that are familiar with commodities. But carbon is really one of the things that attracted me personally to this industry when we started doing work on it 2 years ago, is our carbon projects, our two, use things that are real world examples, our project in Rwanda and our project in Vietnam. As those stoves are being distributed, they immediately start generating you can think about it as almost a inventory of carbon credits, because it's time relative to the methodology of how long the stove's been in the field for the abatement. You still have to go do your verification and ensure that the stoves on a systematic basis are being used in the manner that they were intended to be used under the methodology. But the stove's out there. And base carbon doesn't require any more capital in either of those 2 transactions to get to cash flow. It's so fundamentally different than extractive resources. And I really don't think investors grasp that. The second thing I'd say is because of that, the payback, well, not because of that, but corollary to that, the payback period in those investments is a lot shorter from first dollar on our latest cook stove deal in Vietnam, from first dollar invested to actual payback. So, and then, remember, capital grows. Our full capital commitment doesn't happen until last dollar, is 2 3/4 years at a base case carbon price. That's as attractive as some of the best mines in the world. So for us, and we think there's a lot more knowability in there. So for us, I think that there's a misperception that we may need to go dilute the business to get to free cash flow, and that's not the case. And that gives us a really luxurious position to be in as principals, that we can use our equity cost of capital as the overall cost of capital for our business, and to judge what is accretive or what is diluted for the business, versus, again, extractive resources where your only path forward is to raise the money because that's what you need to do to eventually get the cash flow out of the oil and gas field or the mine.
That's a very important statement that you make there, and I do hope that everyone understands it. You don't need capital to get to cash flow positive. When you raise capital, you're gonna do it because it's gonna be accretive again to everyone, and that those are two very important messages, and it's very different indeed, as you said, from the classical mining industry. I think it answers a couple of questions that were put forward over here, and I assume that it's with the same type of eyes that you will be looking at other ways of financing yourself. If there's an opportunity that is there, you will consider it, but it has to make sense, and it cannot become a burden on the organization, and you don't need it. It's just another way of growing.
Exactly. And I think needs are always a function of accretion. So if we have projects that we're making multiple, we've underwritten, we have edge in them, we have the sourcing on them, it's a question of doing that project. And what is the risky rate that we're going to generate for our shareholders and our stakeholders versus not doing that. But you talked about other ways of raising capital. I don't think people should discount our experience, being able to raise capital, but not with diluting the business. And I'm not talking about taking on debt either. We're not guys that are going to go lever the business. I think it's never say never, of course, but I think that largely for earlier stage businesses of this nature, I think that debt at a holdco is largely inappropriate, just given the stage in the development of the business. But there's many tools that we've that, again, to the point of experience, that we've employed as the financiers, not being on this side of the table with other counterparties, to be able to raise capital into the business but not dilute it. So we like some of those structures. So we think there's a lot of optionality in there for our business and our stakeholders.
Yeah, thanks for that, Michael. I can't believe it. Remember when you asked me earlier, how long is this going to last? 30 minutes are already pretty much over.
I can't believe it.
Goes very quickly, sadly enough. But there's two questions that I still want to ask that are important. I'm going to give them so that people know what I will ask you to answer. The first one is a question that has been put forward, a bit in line of a discussion we had again, and of course, take into account what you can say, what you cannot say, what has been disclosed, and so on. High-level timeline for revenue. And then
go ahead. You can ask them together, and then I'll answer both.
Yeah, I think they come a little bit together. And then the second one, I mentioned earlier. We mentioned earlier, the how interesting a company like yours is, because it is about doing something that has an impact on our environment, and it provides a very interesting risk-reward opportunity. The question is, zooming in now on base carbon, when should I step in, taking also into account the entire environment in which we are operating? We all know what's happening in the markets. We all know that there's a couple of macro components or macro elements that are very impactful on the markets. At the same time, I've seen your stock showing some interesting signs of resistance and even price improvement in the last few weeks. What would you say to potential investors that are looking at investing in a companies like yours? I'm not going to ask you to give advice. We can't do that. Neither you, neither I. But what should they think about? What should they look at? What should they think when they look at a stock like yours and the price at which it is? Like how do we look at all of that as an investor? So question number one, easy one, high level views on when are we going to see revenue coming in, and two, how should I look at your company now as an investor who wants to get in this space?
Absolutely. So question number one is easy. Investors should think about it this way. In our Q2, we've talked about how the timing of distribution of stoves, both for Rwanda, we expect the distribution to be done by the end of the year, and for Vietnam by mid 2023. As I said before, we're ahead of schedule on both of those. And as we talked about, the stoves generate credits as soon as they're in place. So think about an inventory going up. The mechanism to generate revenue on those two projects is, well, the mechanism to get to a voluntary credit, minted credit, if you want to think about that, from the registry, which is Vera in this instance, to be able to sell it either to Citibank through an offtake or into the merchant market, depending on the project we're in, is a verification. We are very, how do I want to say this? We're very focused on ensuring that we have as our stoves are distributed, we do a verification as quickly as we can, but as systematically as we can. So I think that there are some delays at some of the verification bodies. Nothing that is that novel, to be quite frank. So I think that people can think that we're very focused on that, and I think that it'd be reasonable to think 2023 is assuming that we can get to verification, a reasonable time frame for revenue within our business. The second question on valuation, as you said, we're not here to give investment advice, but I'm going to take that question a little bit more to the macro, and just talk about my background and my experience in quote bad markets, especially in the commodity complex. The stocks that always, when you had a market sell off and everything was risk off, what happened was investors generally protected the investments that their favorite ones in their book, and the things that they were building a starter position in or things they were looking at go by the wayside because you have redemptions. Depending whether you're a hedge fund these days with redemptions or a mutual fund, or even individual investors, personal advisors, everybody sort of faces the redemption curve. It's the contraction of duration everywhere in this marketplace. When the market starts to get better, the things that get bought first are large liquid revenue generating names that are probably trading cheap. So the quintessential example is Canadian banks. And as you sort of percolate through the market getting better, the smaller companies get better, pre-revenue companies get better. And I always found, for me as an investor, and I'm not talking about base generally, that of the things that you've done work on that you understand well, that you think are multiple of money returns, if you try to time it perfectly, and try to ride that waterfall down, it never ever works. And I think that for businesses like ours, whereby there is a amount of novelty in the public markets, I think there's a big sphere of public investors that are still coming up to speed on what we do. So I think that we're, in terms of market uptake, we're punching with a subset of the overall market that's had the time, had the bandwidth, had the capital to do the work to really understand what we're doing. And as that awareness penetration proceeds into the overall broader marketplace, I think that when you comp it to other industries where everybody knows what mining is, everybody knows what telecom is, I think that that's a really big tailwind, just from it's not necessarily a macro standpoint, but from a market dynamic standpoint that maybe folks are missing. And it doesn't just affect us; it affects the broader publicly listed voluntary carbon sphere, which is pretty tiny.
Yeah, no, I hope that two things. One, that today we helped our audience, and in the days and weeks to come, because we're going to make sure that this interview is publicized, that we brought more investors up to speed, as you said, because I think it's all about understanding it and getting it. And two, I hope that everyone got the hint, and the hint is that this is a space where there is opportunities, and the environment in which we are is of course impacting these types of organizations, particularly in a novel sector or area. And at the same time, there's a lot of opportunity ahead of us, and this is a kind of timings that you do your homework. That's probably the way that I would say it. You do your homework, you make sure you have a good understanding of what the value proposition is, what the potential and the opportunity is. But it's a market where you look at these opportunities, and it's not something you want to do in a couple of years, because then the market will be in a totally different spot as it is today. So there's no advice in anything we said, but a strong recommendation to have a good look at the opportunities that are out there in this space, and to have a good look at Base Carbon, which I think is a great example of an extremely professional company in this entire carbon project, carbon credit space. Michael, 12:37. I never went that much over time in a spotlight. It just means that this conversation was absolutely great, insightful, and difficult to stop. I want to thank you for that, because that is only possible when you give a lot, and you gave a lot today. You gave insights. You were candid, and you were very straightforward and upfront with all your answers. So thank you for that. To our audience, that I've seen many of you still see many of you there. Thank you for being with us. Thank you for joining. Thank you for the questions. And I know quite a few questions have not been answered, but we will make sure that all of those go to Michael, so that he and his team can get back to you on a one-by-one basis, and we don't leave you unsatisfied after this session. Michael, once again, thank you very much. Thank you very much to everyone else joining us, and looking forward to seeing you at the next NEO Spotlight. Take care, everyone.